Hey everyone, and welcome. Whether you're a diploma-level student diving deep into financial planning or a Canadian small business owner looking to make the absolute most out of your hard-earned corporate profits, well, you're in exactly the right place. I am super thrilled to be your guide through this masterclass explainer. Today, we're going to break down the actual mechanics of mutual fund recommendations and, more importantly, the critical tax strategies you need to master. Think of me as your friendly professor for the next little while, so grab a notebook, get comfortable, and let's get started. Now, I want to start by revealing the ultimate plot twist of investing. It's simply this: higher returns do not always mean higher profits after tax. Investors often get tunnel vision, right? They just stare at the gross returns of a mutual fund. But here's the reality check. It's not just about what you make, it's about what you actually keep after the government takes its share. A poorly selected fund or inefficient tax planning can literally destroy your wealth creation over time. So here's our syllabus for today's explainer. We'll kick things off with investor profiling and allocation, then move on to selecting the right mutual funds. After that, we'll tackle Canadian mutual fund taxation, followed by accounts and tax efficiency. Then we'll look at a real-world tax case study, and finally wrap the whole thing up with ethics and financial advisory. All right, diving right into Section 1, Investor Profiling and Allocation. Rushing to pick a mutual fund before really understanding the investor's a massive mistake. We absolutely must understand the person before a single dollar is ever allocated. Just look at the stark contrast in investor psychology we have here. Over on the left, we've got conservative investors. Their primary behavioral driver is just the sheer fear of loss. They prioritize safety and stability, which makes money market and bond funds their perfect match. But on the right, we have aggressive investors. They're chasing those high returns. They can stomach the wild volatility, and they are prime candidates for equity funds. As an advisor or even managing your own money, you have to guide decisions rationally, because emotional factors like overconfidence or following the herd can derail even the absolute best plans. And think about this: your investment duration directly dictates your asset allocation. If you know you need the money in the short term, say 0 to 3 years, your entire focus has to be capital protection. You're looking at money markets. Now, medium term, around 3 to 5 years, demands a balanced approach, so maybe hybrid funds. But if your horizon is long term, 5 years or more, well, then you can focus on growth and absorb the natural ups and downs of equity funds. Moving on to Section 2, selecting right mutual funds. Okay, once we have a solid investor profile mapped out, we can finally pick the actual vehicles to match it. Check out Figure 1 here. Equity funds carry high risk, but they are what drive that long-term growth by investing in stocks. Bond funds, or fixed income, carry lower risk and give you stable, predictable interest income. And then balanced funds? They sit right in the sweet spot in the middle, offering a moderate risk, hybrid approach. Choosing between these isn't just a guessing game. It's a direct reflection of the profiling we just talked about. But how do you actually choose which specific equity or bond fund to buy? Well, the absolutely crucial point here is to look way beyond just last year's performance. You need to check performance history for real consistency over time. You have to scrutinize the expense ratio, because keeping your costs low significantly improves your net returns over the decades. You also evaluate the fund manager's expertise, and you really have to look at statistical risk measures, things like beta and the Sharpe ratio, just to understand exactly how much risk you're taking on to get those returns. Let's get into Section 3, Canadian mutual fund taxation. Now, this is the heavy lifting. This is literally what separates amateur investors from the truly wealthy ones. Canada offers a massive, massive advantage: the 50% capital gains rule. See Figure 2? When your mutual fund units appreciate in price and you finally sell them, that's a capital gain. And here in Canada, only 50% of that capital gain is actually taxable. The other 50%? Completely tax-free. It's an incredible rule that heavily encourages holding onto your investments for long-term growth. But, and this is a really big but, not all income is treated equally. When your mutual funds pay out distributions, the taxman looks very closely at where that money came from. If it's income from dividends, meaning payouts from corporate earnings, it's highly tax efficient because you get to use the Canadian dividend tax credit. But if the income is from interest, like the earnings you get from those nice, safe bond funds, it carries the absolute highest tax burden. Interest income is fully added to your regular income and taxed at your highest marginal rate. Ouch. That brings us perfectly to Section 4, accounts and tax efficiency. Knowing how heavily interest is taxed and how lightly capital gains are taxed leads us straight into asset location. The type of account holding your mutual fund literally acts as a shield against the taxman. First, let's distinguish between the two main buckets. On the left, non-registered accounts. These are your standard run-of-the-mill investment accounts. They are fully taxable.
That means all your interest, dividends, and realized capital gains are taxed in the exact year you earn them. The upside? You get supreme flexibility and zero contribution limits. On the right, we have registered accounts. These are government-approved vehicles specifically designed with major tax advantages just to encourage you to save.
Let's look at the two absolute heavyweights of Canadian registered accounts in Figure 3, the RRSP and the TFSA. With a registered retirement savings plan, RRSP, your growth is tax deferred. You get a tax deduction right now, the investments grow without any annual taxes dragging them down, but you do pay tax upon withdrawal, which is usually in retirement when your tax bracket is way lower anyway. Now, the tax-free savings account, or TFSA, is a totally different beast. You fund it with after-tax money, but its growth and withdrawals are completely 100% tax-free forever.
So how do we actually put this all together into a real strategy? Through asset location. Remember how we said bond interest is fully taxable? Well, you strategically tuck those tax-inefficient bond funds safely inside your protective RRSP. Meanwhile, you keep your highly tax-efficient equity funds, the ones turning out capital gains, in your taxable non-registered accounts. Furthermore, you want to minimize turnover. Avoid frequently buying and selling just to keep your tax liability down. Using broad index funds is honestly a fantastic way to naturally maintain that low turnover. All right, Section 5, Real-World Tax Case Study. Let's bring these academic concepts to life. Meet Ali. He's a Canadian small business owner who just had a killer year and wants to invest his profits. Ali does his homework, right? He invests $20,000 of his business profits into an equity mutual fund, and he puts it inside a non-registered account. Over time, that investment grows beautifully. He eventually sells the units and realizes a sweet gain of $5,000. Let's walk through the math here on Figure 4 to see exactly why Ali's strategy was so incredibly smart. Because Ali earned a capital gain, that magic 50% rule applies. His total gain is $5,000, but his taxable amount? Just $2,500. His personal tax rate will only be applied to that half. If Ali had earned that exact same $5,000 as interest from a bond fund in that same taxable account, the entire $5,000 would be taxed at his highest possible rate. This perfectly proves why asset location and understanding income types is so absolutely critical. Finally, we arrive at Section 6, Ethics in Financial Advisory. If you're going to step up and guide clients like Ali, or even if you're out there hiring someone to guide you, technical knowledge just isn't enough. It all ultimately comes down to fiduciary duty. This is the strict, unwavering obligation to prioritize a client's needs, goals, and financial well-being way above your own personal or organizational interests. It means recommending what is truly best for the client's specific risk tolerance and time horizon, absolutely not what generates the highest commission check for the advisor. When that fiduciary duty goes out the window, advisors fall into some seriously dangerous pitfalls. These common mistakes include things like completely ignoring the investor's profile, recklessly chasing high returns, or overly complicating a portfolio with unnecessary over-diversification. Furthermore, as we've clearly seen today, ignoring costs or failing to consider taxes can silently wipe out a client's wealth over time. And frequent switching of funds? Honestly, that just generates a bunch of unnecessary tax liabilities and trading fees that benefit no one but the brokerage. To avoid those traps, professionals really have to stand firmly on these ethical pillars of trust. They must provide completely transparent and honest advice, no shady, misleading statements or omitting key facts. They have to explicitly disclose any conflicts of interest right away. They must strictly comply with all industry regulations, and they absolutely must guard sensitive client financial data with ironclad confidentiality. That right there is how you build a credible, lasting practice. So I want to leave you with this somewhat provocative question to chew on. Are your investments truly working for you, or are they just working for the taxman and your advisor? Understanding investor profiles, grasping the profound impact of Canadian tax rules, and demanding ethical advice is exactly how you ensure your hard-earned wealth actually stays yours. Thank you so much for taking the time to hang out and watch this explainer. If you found this masterclass helpful, please do like this explainer and subscribe to the channel so we can keep making complex topics clear, fun, and accessible for you. Until next time, keep learning and invest wisely.